5-minute clock still applies for your questions. At 30 seconds remaining, you'll hear a bell ring to remind you your time is almost expired. It'll ring again when it has expired. If there's a tech issue, we'll move to the next senator until it's resolved. And to simplify the speaking order process, Senator Toomey and I have agreed, and as in other hearings, to go by seniority. A year ago today, we watched for 8 minutes and 46 seconds as police murdered George Floyd. Across the country, we saw Americans demand justice for the killing of too many Black and brown Americans and an end to systemic racism in our country. Over the past year, the pandemic has taken 500,000 American lives, wreaked havoc on small businesses, pushed families into foreclosure or evictions, and forced millions of workers, many women and workers of color, out of the workforce. For most Americans, it's been an arduous, long, difficult year. A year that revealed what many of us already knew, that even before the pandemic, our economy wasn't working for most people. I've heard some people, including many of my conservative colleagues, say that we had the best economy in our lifetime before the coronavirus hit. Those people need to follow President Lincoln's admonition to go out and get their public opinion baths. It certainly wasn't the greatest economy for most people in Senator Toomey's hometown, Rhode Island, or my hometown of Mansfield, Ohio. Workers' wages have been flat for decades. Jobs continue to move overseas. In my hometown, companies like Westinghouse, Fisher Body, Tappan Stove, Mansfield Tire, employing literally tens of thousands of people. Companies like that closed down one after another. Those good union, mostly union jobs disappeared. They weren't replaced by new investment. The creative destruction the market fundamentalists like to talk about wasn't followed by any construction, creative or otherwise. Yet corporate profits continue to climb, CEO pay has soared. Those outcomes are, of course, connected, as we know. Corporations lay off workers or cut pay and benefits to juice their stock price. Companies close down factories, move good-paying union jobs abroad to cut costs. Big banks keep getting bigger, fueling the concentration of corporate power in every part of our economy, from agriculture to healthcare to manufacturing. The economy of the past few decades may have looked good from the big windows of corporate boardrooms, figuratively or literally looking down on Wall Street, or from the Dirksen Senate office building. But the economy hasn't looked great in a long time when looking out from the small towns and rural communities that the big banks have left behind in search of higher profits. And it's never looked all that great for the Black and brown families who lost their homes and wealth in the wake of the Great Recession, barely getting back on their feet before the next crisis hit. When I talk to Ohioans, I hear a constant refrain. People don't trust banks, especially the biggest banks. They've been burned by predatory mortgages and high overdraft fees and expensive second chance accounts. They've watched Wall Street reward themselves despite scandal after scandal. They remember how Wall Street bounced back after they wrecked our economy. They know Washington allowed that destruction to happen, and they certainly remember that taxpayers were forced to foot the bill. Tomorrow, for the first time ever, this committee will bring the CEOs of the 6 largest banks in the country to testify in front of us. Our job is to hold accountable the institutions that for far too long have had outsized power in our economy, power that only continues to grow. Today, we'll hear testimony from the Federal Reserve's Vice Chair for Supervision, the person responsible for supervising these banks. Mr. Quarles, checking Wall Street's power is supposed to be your job too. It's your responsibility to enforce the law, to hold banks accountable for misdeeds with meaningful punishments, not slaps on the wrist, not paltry fines that don't make a dent. For gargantuan Wall Street firms, a fine is just a minor cost of doing business. It's your job to stand up for the people who don't have corporate lobbyists, who don't take millions of dollars a year, who don't get bailouts. As far as I can tell, you don't view standing up to Wall Street as part of your job. You've rolled back rule after rule, rules that are supposed to be a check on the power of the biggest banks and supposed to ensure they invest in the real economy, not in themselves. Instead of investments in job creation and wages and new technology, they continue to pour so much extra cash into riskier and riskier bets and buying back more and more of their own stock. Good for them, but not so good for America. You need to bring the focus back to the people who make this country work. You need to make sure banks are taking into account climate risk. You need to make sure that volatile, unregulated cryptocurrencies don't crash the economy and harm consumers. We need to make sure workers' wages keep up with the cost of living, housing, childcare, prescription drugs, all the expenses have been rising for decades now. We need to close the racial wealth gap and income gap that keeps getting wider and wider and wider. It's our responsibility to work on solving these problems, not for the biggest banks, but for the people whom we serve. If we want an economy that reflects our values, we can't let Wall Street write the rules. We can't tell the regulators how to do their jobs for that matter. Our financial watchdogs shouldn't be doing favors for the biggest banks. Vice Chair Quarles, you work for the American people. I want to hear how you're going to stand up for workers and families and help create a better economy that works for everyone. Senator Toomey.
Thank you, Mr. Chairman, and welcome, Vice Chairman Quarles. Congress has provided the Fed with a great deal of independence in order to isolate it from political influence. However, Congress has also given the Fed narrowly defined monetary and regulatory missions. In the regulatory domain, the Fed has the authority to ensure the safety and soundness of the financial institutions that it regulates. It does not have the authority to seek out and address political or theoretical risks in the distant future. The Fed's recent actions raise concerns that it's losing sight of this constraint. Consider its increasing focus on the supposed risks of global warming to the financial system. In March, John Cochrane, a distinguished economist at Stanford University, powerfully argued before this committee that, and I quote, climate change poses no measurable risk to the financial system, end quote. Put simply, neither the warming of the Earth's temperature nor severe weather events are a threat to the stability of the financial system. Experience bears this out. In the last 11 years, a time period that included 4 of the 5 costliest hurricanes in U.S. history, we haven't found one bank failure caused by any weather event. In fact, we're not aware of any bank failure in the modern era due to weather. Nevertheless, the Fed recently joined the network of central banks and supervisors for greening the financial system. The network's stated aim is to use financial regulation to, quote, mobilize mainstream finance to support the transition toward a sustainable economy, end quote. In other words, to direct credit away from fossil fuels. Such actions are not consistent with the Fed's mandate and authorities. As Chairman Powell himself has said, society's broad response, this is a quote, society's broad response to climate change is for others to decide, in particular, elected leaders, end quote. It's my view that if Congress believes current environmental laws don't adequately address global warming risks, then changes should be enacted through the legislative process by those who are accountable to voters, not by financial regulators who have neither experience nor accountability. This principle extends to other issues as well. I'm troubled that regional Fed banks are focusing on politically charged issues like racial justice activism that are also outside the Fed's mission and expertise. This week, I sent letters to 3 regional Federal Reserve banks about this behavior and requested information from them. Instead of seeking to tackle issues that are outside the Fed's mandate and authorities, the Fed should focus on supervising the risks within its domain. For example, the Fed's recent financial stability report highlights several risks that should be monitored, including high asset prices. However, the report fails to consider a primary cause of these risks, that is the Fed's own excessively accommodative monetary policy. Our economy experienced a tremendous shock last year, but it was met with unprecedented monetary and fiscal support, and the economy is now in full recovery mode. As a result, I don't understand the justification for the Fed maintaining its policy of near zero interest rates and $1.4 trillion in bond purchases per year, amounting to roughly half of all new Treasury debt issuance since the beginning of the pandemic. Let's not kid ourselves. We're effectively monetizing about $1 trillion of federal debt per year. And this is especially trouble because the warning signs of inflation have been getting louder. We may be seeing asset bubbles forming already. And history is replete with examples where the bursting of bubbles led to financial instability. As President Clinton's Treasury Secretary Larry Summers noted yesterday, the Fed needs to start, and I quote, explicitly recognizing that overheating and not excessive slack is the predominant near-term risk for the economy. I'm concerned that the Fed's current approach almost guarantees that it will be behind the curve if inflation does become problematic and persistent for 2 reasons. First, the Fed has announced it will allow inflation to run above its 2% target level for some indefinite period. And second, the Fed insists that the inflation we're experiencing now is just transitory. But you can only know something is transitory when it's come to an end. What if it doesn't come to an end? Another side effect of the Fed's asset purchases is the regulatory implications of such an abundance of reserves in the banking system. When the Fed purchases treasuries or agency securities, the aggregate level of reserve rises correspondingly. As a result, reserves in the banking system have risen by over $2 trillion, and bank leverage ratios have experienced pressure from absorbing these riskless reserves that the Fed is creating. Last year, the Fed recognized this problem and issued temporary relief that allowed banks to accommodate a surge of reserves. That relief has expired, and there are signs that it was needed. The Fed recently stated that it will address this problem on a permanent basis. Mr. Vice Chairman, I hope you will do so swiftly. Let me conclude with this. The Fed doesn't need to exceed its mandate and authorities to find risks to address. The siren calls of politically charged endeavor should be ignored in order to preserve the credibility and independence of the Fed. There are plenty of risks within its reach, including those to which it may be contributing. Thank you, Mr. Chairman.
Thank you, Senator Toomey. I'll now introduce today's witness. We'll hear from Federal Reserve Vice Chair for Supervision, Randall Quarles, on the Fed's supervision and regulation of banks and financial firms. The Federal Reserve, as we know, plays a key role in making sure we have a strong financial system that works for all Americans. Vice Chair Quarles, thank you for your service. Thank you for testifying today. You are recognized. Thank you.
Thank you. Thank you, Chairman Brown, Ranking Member Toomey, members of the committee. Thank you for the invitation to testify today. Last May, I came before you to discuss our actions to maintain a strong banking sector as a source of support for consumers, households, and businesses. My remarks at that time came after the onset of sudden and pervasive financial stress. Early turmoil in overseas markets quickly crossed borders, and within days had reached almost every asset class and corner of the financial system. And a year ago, the full implications of the COVID event remained unclear, and the costs would continue to mount. Today, the storm waters are receding. The economy is beginning a strong recovery to the other side of the COVID event. As the Federal Reserve's recent reports detail, banking organizations have remained an important source of strength in this recovery. Higher levels of capital and liquidity, better risk management, and more robust systems let banking organizations absorb an unprecedented shock while providing refuge from market instability, delivering essential public aid, and working constructively to support borrowers and communities. In short, the full set of post-2008 reforms, as refined and recalibrated by the work of the last 4 years, ensured that this time would truly be different than the last. Today, the U.S. banking system is actually more liquid and better capitalized than it was a year ago. And on top of that, has over $100 billion in additional loan loss reserves, leaving it well positioned to weather future shocks. While a strong recovery is underway, it's not yet complete. Our role as policymakers is to support the financial system and the economy through the end of this transition back to normal operations. Our challenge, however, is to do so as circumstances change and the nation's need for that support evolves. Most immediately, we've worked to align our emergency actions with other relief efforts as the economic situation improves, maintaining or extending some measures where appropriate to preserve household assistance and promote continued access to credit, and starting the transition back to our normal activities, our normal supervisory posture, and our normal rule book. However, our role and responsibility extend much further than merely returning to normal. We also have an obligation to look closely at the last year, to understand how the financial system came to experience such severe stress, and to identify and act on any lessons we find. Any list of lessons must begin with the strong performance of supervisory stress testing. The stress testing program not only prepared banks for a period of prolonged hardship, it also clarified their health and resilience as the COVID event progressed. This role affirmed the ways that stress testing has evolved in recent years into a more flexible, more transparent anchor for the Federal Reserve's broader capital program. For example, while it was sensible, given that this was the first real-world test of the post-2008 system, for us to impose temporary capital distribution restrictions beyond those that are built into the system, we now know that the system works, especially when supplemented and informed by a real-time stress testing regime. In the future, having learned the lessons of this real-world test, we'll be able to rely on the automatic restrictions of our carefully developed framework rather than impose ad hoc and roughly improvised limitations. Other areas, however, are ripe for closer examination. These include strains in short-term funding markets and the second destabilizing run on prime money market mutual funds in roughly a decade. Treasury markets, where last year's selling pressures overwhelmed dealers' ability or willingness to intermediate, and changing patterns in the use of financial services by consumers and businesses. These trends predate the COVID event, but the past year accelerated them dramatically, with important implications for financial stability, safety and soundness, consumer protection, and underserved communities' access to safe and fair financial services. In our work to understand each of these trends, we have valuable and willing partners in our fellow regulators, in other agencies, in our colleagues abroad, and we're committed to keeping Congress closely and actively informed of our efforts. This work is critical, but only in service of a more fundamental goal: a safe, transparent, and efficient approach to supervision and regulation, which ensures the financial system can withstand even historic shocks. Those values are of perennial importance. They continue to be the bedrock of the Federal Reserve's work, animating two of our highest priorities for this year: finalizing the post-crisis Basel III reforms and completing the long overdue transition away from LIBOR. The COVID event is not behind us, and the vulnerabilities it exposed are not gone. But as we now follow the path out from this event, the Fed is working to ensure the financial system is resilient enough to support consumers, households, and businesses, and recommit ourselves to supporting the economy through the completion of the recovery. Thank you, and I look forward to your questions.
Thank you very much, Mr. Chair, Mr. Vice Chair. I appreciate your comments. After George Floyd's funeral, Chair Powell acknowledged, quote, "This tragic event put a spotlight on the pain of racial injustice in this country," unquote. He went on to say, there, quote, "There is no place in the Federal Reserve for racism, and there should be no place for it in our society," unquote. Do you agree with that statement, Vice Chair Quarles?
Wholeheartedly.
Okay, thank you. When we say systemic racism, we mean all the decisions people and institutions make that hold people and communities of color back. You've issued rules that make it easier for the biggest banks to make risky bets instead of investing in the real economy. You failed to take action against banks for lending discrimination. Don't these decisions contribute to systemic racism?
Well, I'm not sure what instances you're referring to that we've failed to take action on lending violations. We're quite aggressive in pursuing fair lending violations and other sorts of discriminatory behavior in the banking industry.
Well, there is. I mean, read the history of the Fed. Read the history of housing discrimination, and we see this Federal Reserve with you as Vice Chair have not really stepped up. It's not just a moral issue, it's an economic one. According to the San Francisco Fed study, our economy has lost $70 trillion over the past 30 years because of racial inequities. We'll continue to hold back our economic growth and competitiveness if we don't unleash all of America's potential. Let me move somewhere else. You said that banks are in strong financial condition, more liquid, better capitalized than a year ago, with $100 billion in loan loss reserves. Is that correct?
That is correct.
Thank you. It's why to me, it's why it's even more troubling that banks are fighting the $4 billion debt relief plan to Black and brown farmers, who, as you know, and your understanding of history of the Fed and history of the banking system and the financial system, those farmers have struggled to get loans and government grants for generations, were systemically denied USDA loans they should have been granted. Banks are going to get back every penny of money they lent, plus 20% on top of that. These USDA loans are guaranteed at 95%, yet banks are still fighting this. The only explanation I can come up with is that they'll block anything that might cut into their profits, even a cent. Let me ask a second question. As big banks buy up their competition and then close local branches, many rural communities are left 30, 40, 50 miles from a place to deposit a check to get a small business loan. The Fed is responsible for approving bank mergers and consolidations, which have led to banking deserts across the country. Do you agree the Fed's contributed to the loss of banks in rural areas?
No, actually I don't. When we look at bank mergers, we among the factors that we take into account, that we're required by statute to take into account and do so seriously, is the convenience and needs of the communities that are served by the merging institutions. And the closing of branches where those are going to be closed, the plans for that are very carefully reviewed by us.
Well, for the last decade, part of that time, well, right after you left the Bush administration and into your time with the Trump administration at the Fed, from 2009 to 2019, we've lost 5,600 bank branches. 20% of branch closings since 2010 have been the only branch in its census tract. The Fed's job is to make sure we have a strong banking system. That includes access, it includes the strength of local communities, it includes access to banking services. And we know if there's not a bank in the neighborhood, so often these are mostly low-income areas, both rural and urban. We know where people turn. They're much more likely to turn to an unregulated, high-interest charging financial service entity. My time's expired. Senator Toomey, you're recognized.
Thank you, Mr. Chairman. As I mentioned in my opening statement, there are a number of troubling signs that the Fed is attempting to get in the business of environmental policy. That, as you know, Mr. Quarles, the Fed's regulatory role is to ensure the safety and soundness of the financial institutions that it regulates. Let me ask you a simple question. I think this is probably a yes or no answer. Are you aware of any banks that failed due to Superstorm Sandy, Hurricane Andrew, the California wildfires, or any other recent weather event?
No, I'm not.
I'm not either. And you can go back quite a ways, and it's hard to find. We haven't been able to find it yet. So it's pretty clear to me that neither the warming of the Earth's temperature, which is occurring, nor severe weather events pose a threat to the stability of the financial system. As Larry Summers said last week, there seems to be an overemphasis of certain risks like climate change by central banks. And here's a quote attributable to Larry Summers. He said, and I quote, "in order to be relevant to something that's on political leaders' minds." So my concern is this will ultimately, end quote, my concern is this will ultimately come at the expense of monitoring the real risks. And the Fed shouldn't be wasting time and resources on what is ultimately a political effort. Let me move on to money market reforms. This past March, you said that the Financial Stability Board will be outlining proposals for further money market reforms. You made a reference to that in your opening statement. Presumably, the impetus for these reforms is market disruptions we saw last spring. Of course, as you know, many markets were disrupted. Even the Treasury market was disrupted. The repo market was disrupted. And it seems very likely that a factor that made things worse for money market funds was the presence of a 30% liquid asset threshold that triggered these mandatory fees and gates. These regulations, of course, were meant to prevent runs, but ultimately it looks as though they had the opposite of their intended effect. My question for you is, if we're going to propose any new regulation, shouldn't we first make sure we fix any flaws in the existing ones?
I do think that the existing regulatory framework has to be something that's looked at, and we are including that in the overall broad review of the issues that led to the money market fund issues last March.
All right, good. As you know, this week I sent letters to 3 regional Fed banks inquiring about what I see as a troubling veer into social policy topics. In particular, some of the banks have appeared to engage in an activity that I think can fairly be characterized as advocacy with respect to systemic racism, which is a very controversial idea that somehow American laws and institutions, including, I presume, the Federal Reserve, are inherently racist in their design. A big concern here is whether the Fed banks are operating well beyond their statutory mandate. Would you agree that if regional Fed banks engage in partisan advocacy, masquerading as research, that advocacy would harm the Fed's credibility and its trustworthiness as an independent and nonpartisan entity?
So let me say 2 things with response to that. The short answer is yes. We have at the Fed, we have a narrow mandate. We've been given significant autonomy to pursue that mandate, and I think that that's important. But that means that we should stay within the lanes of that narrow mandate. I do think that within that mandate, research into breaking down the effects of some of the large aggregate economic numbers, whether by geography, whether by different demographies, can be appropriate, but it should not cross the line into advocacy. It should be analysis.
Thanks. Last question. As you know, the Fed's QE has put capital pressure on banks, and you addressed that with a temporary measure, and I know you've indicated that there will be something more coming through. Do you anticipate more permanent changes in the regulatory regime to recognize this capital pressure?
Well, we're looking at that now. I think our best estimate is that as the level of reserves in the system grows over the course of this year, we will see some of that pressure. There are a variety of ways one could address it. We're exploring them all. We have not decided whether it will ultimately be necessary or what path to propose, but we're looking closely at it.
I hope you will. I'll finish up, Mr. Chairman, but Mr. Quarles, I do think the Fed is imposing this through its unusual activity, which is continuing inexplicably to me. So I do hope you'll look to remediate that. Thank you.
Thanks, Senator Toomey. Senator Menendez from New Jersey is recognized for 5 minutes.
Thank you, Mr. Chairman. I was very happy to see Acting Controller Sue announce the OCC was revising the ill-advised Trump-era Community Reinvestment Act rule. After last week's OCC announcement, I hope to see a joint interagency CRA rulemaking by all 3 bank regulators. This is an important civil rights law that should not be enforced in a piecemeal fashion. So, Vice Chair Quarles, have conversations begun among the agencies on how the Federal Reserve, the FDIC, and the OCC might align their regulatory efforts around the CRA?
We have, throughout the CRA process, as you know, it's been the Fed's position and desire that we would end the process with a joint rulemaking. We've each shared the comments we have received on our separate processes, the OCC's rule, our advance notice of proposed rulemaking. We're all aware of the input that has come from that, and it remains our objective to see a joint rule.
Mm-hmm. I appreciate that it's your objective. The question is, since there is a change at the OCC, I understand what you did before. The question is, are you engaged now in an effort with the OCC to align yourselves?
Well, we're certainly talking with them, and obviously the position of the OCC has changed, and therefore our continuing engagement will, I think, is likely to result in the objective we've always had. But we do continue to talk with them. Absolutely.
Well, let me reiterate how critical it is for all 3 banking regulators to get to the same page when it comes to the CRA. It's especially important having seen the disproportionate impact this pandemic has had on minority-owned businesses and communities. I have a sense that some of my colleagues would think that none of you have any role to play in terms of dealing with the great inequities in our society. I totally disagree with that. And certainly when you have oversight over the Community Reinvestment Act, this is a key tool to try to deal with some of the issues that we face today, for which the CRA was originally created. So I hope you all get together, adopt a unified rule that strengthens the original intent of the CRA, which has never mattered more. Let me ask you, this month marks 10 years since the deadline for finalizing the incentive-based compensation rulemaking, the rule to ban practices that reward senior bank executives for irresponsible risk-taking. In those 10 years, we experienced the London Whale, the Wells Fargo fake account scandal, and most recently, Credit Suisse involvement with Archegos capital management. All 3 instances of corporate malfeasance or mismanagement were tied to executive pay incentives in one way or another. So was the Federal Reserve forced to take some regulatory action to the London Whale and the Wells Fargo fake account scandal?
I guess 2 things I'd say. Well, the London Whale was before my time, and I'm recused from the details of Wells. So those specific questions I'm not sure that I can answer, but I can certainly say that on...
It's a simple question. It's not something that you have to recuse yourself. It's an acknowledgement of what the reserve did, whether you were involved in it or not. My understanding is that there were regulatory actions. And so if there were, if you take my word for the moment, because my time is limited, wouldn't it be more effective oversight to help prevent these types of scandals from taking place in the first place?
We do in our supervisory engagement with the firms. That is an important element of it. There are compensation arrangements, there are incentive compensation practices. As you know, the incentive compensation rule is a joint agency rule that requires complicated joint agency negotiation, but the Fed does closely supervise compensation practices.
10 years, 10 years. I don't care how complicated the matter is. Doesn't take 10 years for great minds to get together and think about what is an appropriate way to deal with excessive compensation. I think preventing scandals and resulting consumer harm is more effective. The Federal Reserve, along with other regulators, have a tool in their arsenal to help curb this type of risky and irresponsible behavior. And yet, after 10 years, the incentive-based compensation rule remains unfinished. That's unacceptable. And I will be pressing each of the regulators to come before us. It's about time to get this done.
Thank you, Senator Menendez. Senator Hagerty from Tennessee is recognized for 5 minutes.
Chairman Brown, thank you. Ranking Member Toomey, thank you for holding this hearing. Vice Chairman Quarles, it's great to see you again, and I appreciate your testimony today. Vice Chairman Quarles, like my colleagues, I'm concerned about the Fed's potential mission creep into regulating social policies. I was pleased with the strength that our financial sector has shown as we've navigated this pandemic. I feel that we've done very well. I was pleased with the financial stability report that talks about the balances and loss mitigation programs at our largest banks being reduced. I think that's a sign of strength right now. And I really am concerned about increasing, with unnecessary regulations, new burdens on imposing social policies, that we really are at a point in our recovery we should not be impeding banks' potential to return to pre-pandemic levels. I'm sure you share those concerns. Vice Chairman Quarles, you gave a speech at the end of last year where you talked about your thoughts on the evolution of bank supervision. In the speech, you noted that your goals at the Fed are to make our regulatory framework more efficient, more consistent, simpler, more predictable. And certainly driving all of that is a fundamental principle of regulation, making it more transparent. You also noted that it's even harder for the Fed, and I agree with those principles completely. You also noted that it's even harder for the Fed to do that beyond the regulatory framework when you get to firm-specific supervision. I agree with that as well. Last week, I'd like to ask you about this. President Biden issued an executive order. That executive order encouraged financial regulators to detail their plans to incorporate climate-related financial risk into their regulatory and supervisory practices. Vice Chairman, how will this directive, which is well outside the Fed's mandate, how does this directive square against the principles that I think you so clearly articulated in terms of efficiency, confidence building, simplicity, and transparency in our regulatory and supervisory framework?
Well, I'd say two things in response to that. First, I do think that it is appropriate and indeed incumbent on us as financial regulators to look at potential risks. Climate change is a potential risk, and to come up with a data-driven analytical framework around that to guide our engagement with the banks and to ensure that the system is resilient to what we determine to be actual risks arising from it. We're in the early stages of doing that. We've developed a process at the Fed for establishing such a framework. I think that, as I say, it's not only appropriate, it's incumbent on us. Also true is that our job is ensuring the resilience of the financial system, not advancing a particular view of climate policy. That's for the Congress, perhaps other agencies. It's not the job of the Fed or other financial regulators. And so we should remain focused on that approach to our climate change analysis as opposed to something broader.
Well, I echo Ranking Member Toomey's view that weather is historically not been a driving force in the resiliency of our banking system, and I do not believe this is a high priority that the Fed should be wasting resources on. I'd like to turn my questions to the next area, which is asset valuations, Vice Chairman Quarles. There's a recent stability report talked about asset valuations and acknowledged the fact that assets are high. We've talked about asset bubbles before. What it failed to mention was the impact of inflation. Yet inflation, we just hit a 13-year high in terms of inflation. And I'm quite concerned about the inflation that we're seeing in our system. I think it's being driven by excessive amounts of government stimulus spending. We've got supply chain dislocations that are lending to this. We've got pent-up demand that lend itself to this. But we have a real concern about inflation. At the same time, we have a tremendous amount of liquidity that have been pumped into the banking system. I want to understand your perspective on what the potential impact of all this liquidity and inflationary pressure is on the banking system today.
Well, it remains my view and the general Fed view that these pressures are most likely to be transitory. As you note, the most recent monthly inflation number was the highest since 2009. But after 2009, we did not experience durably high inflation. And I think it's still most likely that will be the case here. If we're wrong, and of course we could be wrong, I think we have the tools to address inflation before it becomes kind of a permanent part of the framework.
Yeah. Thank you.
Thanks, Senator Tester. Montana is recognized for 5 minutes.
Yeah, thank you, Chairman Brown. And I want to thank you, Vice Chair Quarles, for the work that you and your team have done at the Fed during this crisis. And I want to thank you for your collaboration and your work to truly keep the Fed independent. So thank you for that. Look, there are many challenges we faced through this pandemic and the economic implications that have resulted from this. There are also many challenges that existed before the pandemic that continue to remain. I've been concerned about small business and families in rural communities having access to capital and credit. We've talked about it before. And there's also a lack of affordable, accessible housing across the country. And that problem has only gotten worse during this pandemic. I'm also concerned that there may be new or growing problems that aren't getting the focus that they merit while we deal with this current crisis. This is something that we've visited about before, and I think it's important to consider on an ongoing basis. And I'm sure it's something that you do in this role as Vice Chairman. So are there trends that you're seeing or problems that you're concerned about that we really should be focused on?
It's a broad question, so let me try not to filibuster away the rest of your time with a 5-minute answer.
Appreciate that.
But let me focus on two things. I do think that in our recent financial stability report, we looked at some of the financial issues that I think that it's good for us to be focused on now. I don't put the financial stability risks as extremely high at the moment. I think they're moderate, but questions about asset valuation and the potential implications of that for the financial system are important. One area where I'm particularly focused, both domestically and also in my international work as chair of the FSB, is on the regulatory framework for non-bank finance, where I think we saw that there could be some improvements in that regulatory framework that would make the system more resilient for the next time it faces a shock like March of 2020.
Appreciate that. So as the communities and institutions that you regulate recover from the pandemic and the economic crisis, like many of the challenges we face now, how to address recovery may look different in rural America, frontier communities, than it does in more urban or suburban communities. So in your role, are you seeing differences in how different communities are recovering from this pandemic?
We are. Yeah, there clearly are geographic differences. There are differences between urban and rural. To some extent, there are inevitably going to be, as you come out of an event like this, there are differences in the speed of policy change, and that results in differences in geography. There are differences in some industries are concentrated in a particular geography, and they have greater supply problems than other industries. It continues to be our expectation that over the course of the year, that will tend to even out, but there are clearly differences at the current moment.
Okay, so is there things that we should be doing to help recovery overall? But dovetailing off the last question too, are the things we should be doing to reduce the disparities between communities in their recovery? So both those questions. Overall, globally, and is there something we should be doing different in other communities?
I would say that from the point of view of the Federal Reserve, there's, I think our use of our tools to address this is if we ensure that the recovery proceeds as smoothly as possible, we'll get to the other side of it, and that evening out faster. I think our tools don't lend themselves particularly well to, again, geographically or demographically targeted solutions, and that our job is best performed in ensuring that the overall economy is moving in the right direction as fast as possible. Other more targeted solutions, are the realm of Congress, and I wouldn't presume to tell you what you should or shouldn't do there.
We always appreciate your input. Anyway, thank you very much. Thank you, Mr. Chairman. Thank you, Vice Chair.
Thanks, Senator Chester. Senator Tillis of North Carolina is recognized for 5 minutes.
Thank you, Mr. Chair, and thank you, Chair Quarles, for being here today. And thank you for your time over the years. I find you to be highly accessible, and I appreciate the time we spent talking just this week. I want to get back to something that we discussed, and it relates to the MRAs and the MRIAs that the Fed supervisors send to financial institutions. Those are matters requiring attention, really reflecting potential issues supervisors find. I understand a lot of that information is designated as confidential supervisory information. What I believe that means is that when they receive an MRA or MRIA, that they're really prohibited from disclosing that information to anyone, including their elected representatives. I see a problem with that. For all intents and purposes, that puts a Fed supervisor in a judge, jury, and executioner role, and I think that the supervisory decisions can limit a company's dividend, their business decisions, their hiring decisions, and pretty much any business action. Even if they disagree, they don't really have any recourse. That seems problematic to me. I know you're a lawyer, and I'm not, but it seems like this is pretty foundational. One question, or I guess the question that I have is why the Fed would need to self-impose this requirement, excuse me, and why is it that the banking institution doesn't have the flexibility to share information that may be in a confidential supervisory letter, but to share that information and advocate in instances where they disagree with the supervisory position? And more importantly, where in the law does the Fed have this authority to impose this restriction on financial institutions?
So I think there are a number of fair points there. First, the due process guardrails around our supervisory activities, I think, are important. As you know, I've made that a theme of mine at the Federal Reserve, that we need to think more carefully than we have in the past about how to impose those. Transparency is important in supervision as well as respect to regulation. Now, the Federal Reserve Act and other banking statutes do acknowledge, they have historically acknowledged, that there can be concerns with the disclosure of supervisory information, even by the affected firm, which can lead to contagion to other firms. It can be misunderstood. It can cause, a perception that there are greater problems at a firm than there are, depending on how a particular action may have been worded, understood between the supervisor and the firm, but perhaps susceptible to misinterpretation. So we have historically been cautious about the release of individual firms, including supervisory information, including by those firms. But we are trying to become more transparent about it. In the supervisory report that we delivered to you today, or have delivered in the past, we discuss sort of in the aggregate MRAs, MRIAs, what they deal with, the number of them. So we're trying to increase transparency around that to allow this sort of discussion and engagement without crossing the line into, potential risk to individual firms from disclosure of their CSI.
But would it make sense that if there was a potential risk to an individual firm, that they themselves would not want to disclose that and work with the Fed? I'm talking more about issues that an institution may disagree with. It seems like right now they have a gag order on even talking about that. And I don't really see anything that provides them with due process, mainly because I do believe in the judge, jury, executioner sort of context that they're operating in now. So what could we do to put meat on the bones of the concept of transparency when all the control is in the control of the Fed or the Fed supervisors?
So I think, I don't have an answer for that today. That is something that that I have given thought to. These are practices that have obtained for decades, really. They become more important in recent decades with the expansion of the supervisory activities, and I think that we should be paying more attention to it at the Fed as to how to square that circle.
Thank you. I look forward to continuing to keep an intense focus on this. And I also want to thank you for a lot of the regulatory reform that you did to kind of ease the burden on the industry. I believe that you played a very important role in doing that, and I wanted to thank you publicly for it. Thank you, Mr. Chair.
Thank you, Senator Till. Senator Warner from Virginia is recognized for 5 minutes. And Senator Warner, I'm going to go slip into the Finance Committee as you do. And if you would next either call on Senator Lummis if she's there, or Senator Cortez Masto if there is no Republican here, if you would do that. Thank you.
Thank you, Mr. Chairman. And Vice Chairman Quarles, it's great to see you again. I want to raise a couple of subjects that I know we've talked about in the past. One is, we know over the last year with COVID, we've seen disparate economic effects, particularly communities of color have been hard hit, particularly women-owned businesses have been hard hit. One of the things that we've talked about in the past is a relatively small piece of the financing sector, but one I think that has great potential to grow, is that's CDFIs, Community Development Financial Institutions. I worked with folks on this committee, and including Senator Crapo last year, and we got a $12 billion commitment to both do grants and Tier 1 capital into these CDFIs. I'm happy to see Treasury rolling that out. The Fed also obviously has a role here in terms, and I know Senator Brown raised this, in terms of CRA activities. We also saw during the pandemic that the Federal Reserve's Paycheck Protection Program liquidity facility helped produce some liquidity relief to CDFIs. I'd like you to speak to that, and on a going forward basis, how we can not only help CDFIs, but also even community banks that may be trying to lend into some of these disadvantaged communities that's been tough to do in the past.
Certainly. Thanks, Senator. Well, we do have a very active program with respect to CDFIs and as well as MDIs. We're working with the Treasury and the Emergency Capital Investment Program. We're providing that provides capital directly to CDFIs as well as MDIs. The Fed, as well as the OCC and the FDIC, released a rule in connection with that program to help implement the assistance by giving regulatory capital treatment for instruments that are issued under the program. We've provided we've provided a set of frequently asked questions on our website so that CDFIs can be better aware of how to take advantage of it. We host regular Ask the Regulator sessions.
My hope, I know you're kind of going through I hope we can keep working on this. And again, a topic that I won't ask you to comment on today, but I try to keep familiarizing my colleagues with, we've been working on, I think, a very interesting proposal that for first generation home buyers, and again, that would help people across all demographic backgrounds, a mortgage product that would include a interest rate subsidy that would have the homeowner, in a sense, pay the same normal amount they'd pay on a 30-year mortgage, but they would actually be obtaining a 20-year mortgage. The ability of wealth building literally doubles if you have a 20-year mortgage versus a 30-year mortgage. And when we're looking at a wealth gap that's basically 10-to-1 between Black families and white families, 7-to-1 between Latino families and white families, if we can build more equity on a quicker basis in home buyers, and I would ask my colleagues and to trust me on the math on this, more to come, but I do want to keep raising this, and again, hope we can get broad bipartisan support as we get more details. So I apologize about my little commercial there. I know we've discussed this, and I think you're intrigued, Sally, on how we could do something that wouldn't drive up the cost of the real estate or drive up the pricing when we have such short supply, but actually might address the some of the wealth gap issues. In my last 50 seconds, I just want to raise the issue of cryptocurrencies. I mean, we've seen the EU come forward with a fairly broad-based report on crypto. I see some value in distributed ledger, but the volatility amongst some of these entities concerning me. I see some of the illicit use from from my role on the Intel committee. Can you speak to this? What else do we need to give you and the other regulators to get this under some semblance of order?
We, along with the OCC and the FDIC, are engaged right now in what we're calling a sprint in seeking to pull together views on exactly that, on a common regulatory framework, the capital treatment, the operational treatment, and in the course of that, if there are gaps in the regulatory framework, we will also make those known.
Well, look forward to continuing working with you. I think we do need to get a structure here. I don't know whether is calling a Republican colleague. Is Senator Loomis or Senator Rounds here? If not, I'm going to.
Loomis is here.
Okay. Senator Loomis, please.
Thanks, Senator Warner, and welcome to the committee. I'm delighted that you would join us today. There have been concerns in Europe that Basel III's net stable funding ratio requirement might cause changes or adjustments for certain commodity markets, including gold. My question is, do you see any concerns in the United States about this? And how can we ensure the July 1 deadline makes a smooth implementation date?
So I'd say that we have not seen evidence currently of that phenomenon in the United States as we approach implementation of the NSFR. Now, we have provided a long runway towards implementation of the NSFR. We had a very comprehensive comment process in the United States. We took account of many of those comments in implementing our final rule, and we provided a lot of advance notice to firms as to how to prepare for it. So I do think that we have done a fair bit to ensure that that transition is smooth.
Thank you. I'm going to switch over to the project that Wyoming's done to complete its regulations and bank examination manual for digital assets. It covers issues like digital asset volatility risk, money laundering and sanctions requirements, custody, digital asset receivership, and capital standards. Can you provide an update on the FFIEC and Federal Reserve's work towards the creation of a supervisory framework for bank digital asset activities?
The OCC, the FDIC, and the Fed are working together, again, in what we've been calling a sprint. So over a relatively concentrated period of time to pull together all of our work in digital assets and to have a joint view, a joint framework for their regulation and supervision of practices with regard to them. We're in the middle of that, or actually in the early stages of the sprint. So it would be premature for me to tell you where that's going to turn out. But this is something that is a high priority, not only as a matter of importance, but as a matter of chronology. And we expect to be able to give at least some results from that soon.
Well, and while you're doing that, I want to refer you to the work that Wyoming has done. The Wyoming Division of Banking has done this securities examination manual. It has done this special purpose depository institution custody and fiduciary examination manual. It has done this SPDI, Bank Secrecy Act, anti-money laundering, asset control examination manual. It has done this risk examination manual. It has done the BSA, AML, and FAC compliance for these. It has done the examinations manual. Here it is. It's done the information security for SPDIs. It has done the payment system risk compliance here. We've got 771 pages of ways to assist you in understanding all of the hard work that Wyoming has done to provide a template for your good work. So I just want to point out that you have a good roadmap in front of you for future reference.
I appreciate that, and I hope that when we're done, we have something that is nearly so comprehensive.
Wonderful. Thanks. Could you comment on the positive role of community banks in providing credit during the pandemic, especially facilitating the Paycheck Protection Program, and especially in rural states like Wyoming?
Community banks were essential in the PPP program. They were a critical part of the distribution mechanism, in part because of their broad reach into their communities and their sort of deep knowledge of particular customers. I think it would have been difficult for the PPP program to have worked without the participation of the community.
Thank you, Mr. Chairman. You hit the 5-minute nail on the head. I appreciate your appearing before the committee today, and I yield back.
All right. I think that means that I'm up next. So I'll go ahead and get started. Last month, a hedge fund called Archegos imploded after making some very risky bets, and some of our biggest banks had loaned Archegos the money to make those bets, even though the hedge fund was managed by a guy who had already been charged with insider trading and banned by regulators from handling clients' money. Now, those banks suffered $10 billion, that's billion, dollars in losses as Archegos collapsed, with more than half the losses hitting one bank in particular, Credit Suisse. So, Vice Chair Quarles, your job at the Fed is to oversee the safety and soundness of our banks. And last year, you made the decision that Credit Suisse and a few other big foreign banks no longer should be required to participate in a Fed program that was designed to oversee the riskiest banks, the Large Institution Supervision Coordinating Committee, or LISC. Is that right?
Yes, although it didn't change the intensity with which
so
we
you're the one who said we're not going to do that. So at the time, you justified dropping these banks from increased supervision on the ground that these banks, and I have it here, have significantly shrunk their U.S. footprint, and their U.S. operations are much less risky than they used to be, close quote. Your timing, of course, was impeccable on this. Just a few months later, Archegos blew up and resulted in billions of dollars of losses to Credit Suisse. So now, Vice Chair Quarles, before you told the banks like Credit Suisse that they didn't need extra scrutiny from regulators, before that, did you see any warning signs that these banks had some deficiencies in their risk management?
Well, the losses that you're referring to, the great bulk of the Archegos losses occurred outside the United States.
Yeah, are you saying that losses outside the United States can't affect operations inside the United States by these large multinationals? Surely not.
But we don't supervise their operations outside the United States. So their operations within the United States have shrunk, exactly as I said.
So you're going to stick with your original play. You know, in 2019, back when Credit Suisse was subjected to the Fed stress test, the Fed, quote, identified weaknesses in the assumptions used by the firm to project stress trading losses that raise concerns about the firm's capital adequacy and capital planning process. In plain English, the Fed said that Credit Suisse's models just weren't realistic. So I want to put the timeline together here. In 2019, Credit Suisse fails a test because it can't accurately project its trading losses. In 2020, you, Mr. Quarles, decide that Credit Suisse should be subject to weaker supervision. And then in 2021, a headline shows up in the Wall Street Journal that reads, quote, Credit Suisse had surprise $20 billion exposure to Archegos investments. So let me ask this, Mr. Quarles, do you now agree that you made the wrong decision to weaken supervision for a bank like Credit Suisse?
Senator, we did not weaken the supervision of a bank like Credit Suisse. The civil servants who are supervising Credit Suisse in our large bank and foreign bank operations
took it out of the program
would take issue with you.
I'm sorry, you can't just say you didn't weaken it. You took it out of a program that was designed to have enhanced supervision, saying you didn't need the enhanced supervision. That's what you said at the time, because their footprint in the United States had shrunk.
I didn't say it was supervision, ma'am. I said it was more appropriate to supervise them with other foreign banks of the same size footprint in the United States, which is what we do. Other foreign banks with similar prime brokerage operations that have long been supervised outside of LISC because their footprint in the United States is smaller. These banks are now smaller. The losses that you're referring to did not occur in the United States.
I
would not have been able to pick them up in LISC or otherwise.
I'm stunned by your argument that you want to say that there was no warning sign from the fact that $10 billion in losses could have affected what Credit Suisse was doing here in the United States. Look, we dodged a bullet with the Archegos collapse this time, but what slipped through the net by regulators to contain these losses when things go wrong was relatively small to what could have slipped through. It could have been an even bigger failure. And that is because instead of protecting the system, you spent your time at the Fed cutting holes in the safety net whenever you could. Your term as chair is up in 5 months, and our financial system will be safer when you are gone. I urge President Biden to fill your role with someone who will actually keep our financial system safe. Thank you.
Thank you, Senator Warren. Senator Van Hollen from Maryland is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Vice Chairman Quarles. And let me start by associating myself with the comments of Senator Mark Warner with respect to CDFIs and MDIs. And I know this is something the chairman and many of us have been working on. I also want to commend the Fed for moving forward on the real-time payment system. I thought it was too late in getting started, but I am glad you're all working to try to make up for some lost time. I see that a pilot program will be launched later this year. and that the full rollout date is now scheduled for 2023. Two questions on other issues. First, on the issue of central bank digital currencies. I'm glad to see the Fed moving forward with issuing a report on central bank digital currencies that will include public input, and that the Fed hopes to play a, quote, leading role in the evolution of international standards. I don't think we can afford to have the United States fall too far behind on this measure, especially given China's moving ahead with their own pilot program. I recognize that there are lots of issues. Can you tell us more about where we are in researching and developing a C? And can you tell me whether or not the Fed would have existing authority to launch a pilot program if it so choose, or do you believe you need congressional authority to do that?
Well, so as you've noted, we are beginning a process. Chair Powell announced it last week of doing a very deep and comprehensive study of sort of the potential of the issues around central bank digital currencies in the United States. There are, as you've noted, there are a host of issues. I think it would be, I think ultimately what that study will lead us to is to a conclusion as to whether a CBDC is appropriate for the United States. I think, that's very much an open question currently. As to whether we have the authority to implement a pilot program or to implement a CBDC, I think that depends on how the structure of the CBDC is, on how we structure it. There are certain structures that we could perhaps do under current authority, but most of the types of CBDC that I discussed would require additional legislative authority to actually use. We are engaged in a pilot of sorts of testing out the technology around CBDC with MIT. Currently, the Boston Fed and MIT are working on this technology pilot. But a broader pilot, and certainly a CBDC itself, is most likely to require additional legislative authority.
Well, I'd appreciate it if you or your colleagues can get back to me on exactly what additional authority that you would need to do a more expansive pilot program or move forward with the full decision. Let me ask you about the issue of the Fed's efforts to take into account the risks of climate change. I was glad to see the Fed recently created the new Supervision Climate Committee to strengthen its capacity to identify and assess financial risks from climate change, and a Financial Stability Climate Committee as well. Mr. Quarles, when can we expect to see the Fed's framework on climate change, or any recommendations, reports, or deliverables that will be the product of these two committees?
Well, unfortunately, I can't give you a timeline today on when we'll have a sort of publicly available framework for comment. I can certainly commit that we will be very engaged in that process of getting public input, getting input from Congress on our thoughts, and that it is important that we develop a framework promptly, and one that's based on data and our own experience.
Well, Senator Schatz and I and some others are going to introduce the Climate Change Financial Risk Act, which we introduced last Congress. We'll be reintroducing it to establish a group of scientists and economists to look at these issues and hopefully inform your decisions. You agree that the standardization on climate risk data will be important from a supervisory perspective. In other words, to develop clear standards so that we can compare apples to apples in this conversation.
Yes, I did.
Well, thank you. And I do look forward to hearing from you with respect to a little better idea of when we can expect those recommendations from those two reports. Thank you. Thank you, Chairman Brown.
Thank you, Senator Brown. Senator Cortez Masto from Nevada is recognized for 5 minutes.
Thank you, Mr. Chairman. Vice Chairman Quarles, welcome. It's great to see you again. Let me start with an issue around an unbanked population. So the latest FDIC report shows that 6.3% of the population in Nevada is unbanked. And as the federal government continues to allocate assistance from the American Rescue Plan, such as the child tax credits, what steps can the Federal Reserve take to ensure that more individuals have access to bank accounts and financial services in order to receive this assistance?
So I think that as you've noted, the COVID has shown some of the specific ways, has highlighted some of the specific ways in which the unbanked are disadvantaged. And we do participate in a number of efforts to try to increase the number of citizens with bank accounts. We include that in our CRA evaluations of banks as to whether they are the efforts that they are taking to ensure that that all the members of their communities have access to bank accounts at those institutions. And we participate in something called Bank On, which is a program with the banks to promote access to standardized, very low cost transaction accounts for all Americans, particularly those who are unbanked.
Thank you. Vice Chairman Quarles, in your testimony, you call for, and I quote, further review of changing patterns in the use of financial services by consumers and businesses, and a changing relationship between banks and their non-bank partners. Can you further elaborate on that? What are you talking about? What I've heard earlier in conversation about fintech or cryptocurrencies or the unbanked. I mean, what are you thinking there? Because you're right, the consumers and businesses are going to be driving this, and I'm curious what the Fed's review looks like in this space.
Yes, well, the short answer is all of the above. Technology of a variety of forms, whether that is partnerships between banks and fintech firms, where the fintech firms provide the consumer interface principally, and the banks provide the plumbing, or in some cases, fintech firms are seeking to operate without banking partners, and what the potential implications for that are. In some cases, they are able to operate more cheaply. Or perhaps that can be a tool to address inclusion. But it raises issues for how we think about the supervision of those firms. There are other aspects of technology where you've got sort of very large tech firms that are increasingly providing services to the banking industry. And how do we supervise the operational and potential financial stability risks associated with those relationships when historically our traditional focus has been on the banks? We have the authority under something called the Bank Service Company Act to examine these third-party firms, and we need to work through a framework as to exactly how we would do that more robustly as these relationships grow.
Well, thank you, and I big task, and I understand that you talked about ensuring the stability, safety, and soundness of market as well. I get that. To what extent do you bring in consumer protection? Is that part of what you're looking at, as well as the Fed, to ensure there, from the business and consumer perspective, that there's protections in place?
Very much so. As we look at issues like the use of artificial intelligence, either by banks or by fintechs, assuring that these various technologies do not exacerbate risk to the consumers, that they are being operated with that in mind, is something that we're very focused on.
And then briefly, I've got about 40 seconds left. How is the Federal Reserve considering stress testing to assess how prepared individual firms and the overall system are to respond to and recover from a systemic cyber event?
So we do run tabletops, and we don't really run what we would call stress tests there to determine capital charges associated with potential cyber event risk. But we do, we are very heavily engaged with firms on their cyber exposure.
Thank you. Appreciate it today.
Thank you, Senator Cortez Masto. I'm not sure if Senator Moran is available. Then I will Senator Ossoff from Georgia is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Mr. Quarles, for your service and for your testimony today. What do you assess to be the most significant risks to macroeconomic and financial stability at growth over the next 2 to 4 years?
So I would say I begin by saying that I think that the overall risks to stability, to financial stability, are only moderate. I don't think that we're in an era of especially large risk to financial stability currently. I think that the COVID event has highlighted that, at least to my mind, the particular risks lie largely in the improvements that can be made to the regulatory framework around non-bank financial institutions and the potential exposure of non-banks in the financial sector to be a source of instability. Again, I don't think that risk is large currently, but I think that that's certainly what I'm focused on, particularly in my international work.
At what corners of capital markets and the financial services industry do you think regulators lack sufficient visibility to make informed decisions about risk and whether their authorities are sufficient?
That's a good question. Do we need additional data? Obviously, most of our data, certainly at the Federal Reserve, comes from our supervision of the banking system. For the most part, I would say that our supervision of risks in the non-banking system, the information that we get from the banking system's relationship with the non-banks, has been adequate for us to be able to judge risks in the non-bank sector. But obviously, we don't get that information directly from those firms, and there are cases where there are data gaps from the non-banking sector as to the exact state of the risk that they face.
Thank you. As the Federal Reserve contemplates its posture moving forward with respect to interest rates and quantitative easing, how is labor force participation, the predictable disruption to labor markets that's resulted from this pandemic and which persists today, and the dynamics in labor markets unique to this shock and this moment, how does that affect you and your colleagues' reading of the strength of the labor market, the unemployment rate, as you contemplate potential changes to your posture, targeting unemployment, price stability, and fulfilling your mandate?
So, as you know, we revised our monetary policy framework, particularly in how we think about these labor market issues, labor market strength measures, relative to when we think it's appropriate to begin withdrawing accommodation, and to say that we really need to see the data coming through on improved employment numbers before we would, before we think it's we will act. We will wait to see that data, whereas in the past, we might have said, based on our projections, we expect to see that data, and in order to remain ahead of the curve, we'll act now, even before the actual employment figures improve to where we think they're going to be in, say, a year. Our experience over the course of the last decade has shown that when we had that slower reaction function, when we allowed employment to improve, to continue to improve past what would have been our traditional measures of a level of unemployment that would have accelerated inflation, that we did not get inflation, and we had significantly improved employment outcomes. I'm a person who believes that we should listen to the data. We should believe it, and so we will wait to see that actual data before making some of the moves that we would have made sooner in the past.
Thank you, Mr. Quarles. I've got just 20 seconds left, but if you could please comment on the financial situation of households in the lower quintile in terms of wealth and income. What do you think are the structural impediments to improvement in the financial condition of low wealth and low income households, and how much progress have we made over the last few months, please?
Well, I think the principal impediment is an improved economy. And I think our job at the Fed is to continue to provide support for a rapid recovery of the economy, which will help all demographies.
Thank you, Mr. Quarles. Thank you, Mr. Chairman.
Thank you, Senator Ossoff. Senator Warnock, we believe, is on his way. Senator Moran's office is still on the screen. Let me run through, make sure anybody that might want to ask questions that hasn't yet. On the Republican side, Senators Shelby, Crapo, Scott, Rounds, Kennedy, Moran, Kramer, and Daines. And on the Democratic side, Senators Reed, Smith, Sinema, Warnock, and Senator Moran has just returned. Senator Moran, you're recognized. Your camera just went off. Senator Moran, you're recognized for 5 minutes if you can stay and do that. Randall, as you know, this is a little different time to do these hearings this way. Senator Moran, you're recognized for 5 minutes.
Chairman, yeah, I'm on. Thank you. Chairman, thank you very much. Mr. Quarles, thank you for your presence today and your service on the Federal Reserve Board of Governors. I want to talk about Basel III. You stated that implementation of the so-called Basel III endgame is a priority item for rulemaking proposal for public comment expected later this year. Would you provide me, the committee, with your perspective on how best to maintain the tailoring rules recently implemented?
Tailoring the regulatory framework will remain a principle that we have in mind as we come out with proposals to implement the final pieces of Basel III, of which the most important are the capital charge for operational risk and what we call the fundamental review of the trading book, or a capital charge for trading risk. For the most part, I don't think those. I think those rules will in many cases tailor themselves. They're addressed principally to larger firms, but we will certainly have in mind the principles of tailoring that we have used in our regulatory work over the last 4 years, and that we use in implementing S2155.
Mr. Quarles, let me see if I can build on that. Despite some objections that the Fed has been getting Dodd-Frank and putting financial stability at risk with the recalibrating of its regulations and supervisory framework during the past few years, over the past year, the banking system has proved to not only be incredibly resilient, but one of the primary sources of strength in the U.S. economy. Would you expand on why right sizing of regulations proved effective over the past year and how we should go further in those efforts? And I'm really talking about response to COVID and the challenges of our economy. We've come through this pretty well in that sense. And what's the lessons learned, and what do we need to be doing in the future?
Yes, well, I think the lessons learned in the most fundamental sense are that we did have a strong banking system, that we had a banking system that was, that was able to support the real economy. It served as a source of support for the real economy. That the measures that were taken, both post the financial crisis in improving capital and liquidity, and to make that framework more efficient over the course of the last 3.5 years, both worked together to create a strong regulatory environment for that to obtain.
Thank you very much, Mr. Chairman. Thank you for the opportunity to question.
And seeing no one else ready to testify, we will close the hearing. Thank you. Thank you, Vice Chair Quarles, for being here today and providing testimony. For senators who wish to submit questions for the record, Senator Warnock is on. Senator Warnock from Georgia, you're recognized for 5 minutes. Ready or not? Maybe he hasn't heard. Can you hear? Senator Warnock, you're recognized for 5 minutes.
Hello, can you hear me now?
Here we go. Yes, we can hear you perfectly. Thank you.
Great. Thank you, Chairman Brown. And Mr. Quarles, thank you so very much for being with us. The Community Reinvestment Act addresses how banks must meet the credit and capital needs of the communities they serve. Congress, of course, passed the CRA, as you know, in 1977 in response to real problems like redlining, a practice by which banks discriminated against prospective customers based primarily on where they lived or their racial or ethnic background, rather than their actual credit worthiness. So the CRA not only addresses a harmful legacy of discrimination in lending, but also racism and bias in our current lending system that harms communities and blocks wealth building opportunities. So I was happy to hear about last week's decision by the OCC to halt implementation and reconsider its controversial CRA rulemaking, which started under the previous administration. This proposed rule would have watered down this important civil rights era legislation and harmed many working class communities. Vice Chair Quarles, the Fed also has oversight authority over the CRA and was notably absent from last year's rulemaking. Do you believe a joint CRA rulemaking with the Fed, OCC, and FDIC is important to ensure we do not leave our most vulnerable communities behind?
Yes, Senator, I think it is both important and desirable and achievable for our three agencies to have a joint rule and approach on the CRA.
And so will you commit to working with the OCC and the FDIC to issue a joint CRA rulemaking?
So we're certainly working with them to do that. That's long been our stated goal. We are regularly talking with them. As you know, Senator, the Fed put out its own advance notice of proposed rulemaking with our own sort of CRA improvement framework. We're sharing the information that we've gained from that process with the OCC. The OCC is sharing the comments that they got during their process with us. The three agencies are engaged in joint discussions. It does remain very much our objective. And as I say, I think it is achievable for us to have a joint rule.
I agree, and I think it's much more important for us to get the reform right than to do it quickly. And so I'm hopeful that you will gather feedback from broad and diverse stakeholders to make sure that we get a joint rule and make sure that we get the CRA reform right. Thank you, Mr. Chairman. I'm going to defy Baptist preacher gravity and close with 2 minutes left.
Well, no Baptist preacher I've ever listened to. So thank you, Senator Warnock. Thank you to witness. And I want to find Senator Warnock, just for your information, we will follow up with you on that CRA. That is really important. And we've been talking to all three regulators, and Senator Warnock's right on exactly where we want to go on that. So thank you. Thank you, Mr. Quarles, for being here today and providing testimony. For senators who wish to submit questions for the record, those questions are due